Hello everyone and welcome to my video blog. My name is Nurpen and in this video we will see how to take a look on earnings of business for stock analysis. Before we move ahead, I would just like to inform you this video is part 2 of earnings video. You are requested to watch part 1 in which gross sales revenue, net sales revenue, gross profit, net profit, profit margin and earnings per share were discussed. You can find link to it in description of video. Now before we understand how to analyze earnings, keep in mind most technical investors, techno-fundamental investors and system-based investors like me analyze stocks with belief market works on discounting mechanism, which in short means security market do not trade in present. All prices in any security market reflect future. Stock prices do not move in light of present events. They move on anticipation of future. Any good book on technical analysis usually starts by explaining discounting mechanism of market. It hardly takes 1 or 2 paragraphs in book but explains why stock prices may fall in spite of good result whereas rise in spite of bad results. Technical analysts who still struggle to understand what is discounting mechanism, just keep in mind it only means all prices reflect future. No price action occurs due to present event. In this video too, we will try to take a look on earnings and its influence on stock prices with respect to discounting mechanism of market. There are 4 ways based on which we can analyze earnings of business. First is based on estimated versus actual earnings, second based on yearly earnings, third based on quarterly earnings, and finally business model specific earnings. So let's start with estimated versus actual earnings. It is also of 4 types. The 4 types are actual earnings, projected earnings, consensus earning and trailing 12 months aka TTM. The actual earnings are those earnings that appear on income statement as net income, net profit or profit after tax. If people are already expecting some number on result declaration day, a report of higher earnings than expected earnings usually drive prices higher. If reported numbers are good but still less than public expectation, prices slide down without upward move. If prices move higher, some kind of profit booking is also not uncommon. But if prices continue to move higher after profit booking, then it means people are also positive about results of next quarter. And most likely by pushing prices higher, they will discount the movement that was supposed to happen in next quarter. Keep in mind sometimes hope of earnings can drive prices more than actual earnings. The price rally that continues long after declaration of result is also called post-earning drift or PED by some investors. For example, here is earnings and monthly chart of IndusSwift Labs. As you can see, rally started in December in expectation of good March earnings. When March earnings got declared, prices didn't move because upside already happened in December. Now if we look at same stock in weekly time frame, we can see post-earning drift in action. Due to discounting in December, prices failed to rise in March, but price rose later as PED. Keep in mind there is no guarantee discounting and PED will happen for sure, but when they happen, you should be ready to take advantage of it. Next is trailing 12 months earnings, also known as TTM. It is nothing but addition of most recent 4 quarters. It is mostly used to gain perspective on how business is performing in latest 12 months. If each new TTM is better than previous TTM, then business is showing accelerated earnings. For time business manages to outperform last TTM with good margin, business remains in strong upside. If due to any reason people feel the next reported earnings will not increase TTM, prices may either halt or decline for a while. Failure to maintain accelerated TTM ultimately results in downtrend. If you are confident that business is going to outperform last year with good margin, then quarter in which TTM was lower than last quarter is best time to buy a rising stock. It will also offer you low risk on purchase. Next is projected, estimated or future earnings. These are nothing but expectation of future earnings by different analysts who are tracking business for investment. Projected earnings are of 2 types, guided and revised. While reporting earnings, business may also provide their outlook on how they will perform in next and later quarter and what investors can expect from yearly earnings. This outlook is known as guidance, and earnings estimate based on it is known as guided earnings. Usually businesses are conservative on their earnings and don't guide a number they are incapable of beating. Failure to hit the guided number multiple times usually results in distrust among investors. As a result, stock may get dumped with huge volume. Guidance is used by business analysts to estimate earnings of business. But in case due to some reason, if analysts increase or decrease his or her estimate, then that is called as revised earnings. A positive revision by many analysts is considered as good, whereas negative revision is considered as bad. If current quarter is revised as bad, but there is positive emotion about next quarter, then current revision can offer good chance to buy if stock is already trending. Finally, consensus earning is average estimate of earnings if estimates has been provided by multiple analysts. Then we have yearly earnings. Yearly earnings are nothing but comparison between current and last year's earning. Yearly earnings are of two types, steady and fluctuating. As the name suggests, steady earnings means making more profit than each previous year. For a time business keeps reporting steady earnings, business remains in secular uptrend. A business with steady earning always maintains a very good cash flow statement. In front of you is chart of Page Industries. It has reported steady earnings growth since year 2009 and has remained in secular uptrend since then. It even held itself from falling down during stock market crash. For time Page keeps reporting more and more earnings, nothing can stop it from going even higher. Finally, keep in mind earning growth should also come with net sales. If net sales is down but earnings are up, then there is something fishy going on. The next yearly earning type is fluctuating earnings. As the name suggests, in this type, business fails to maintain steady growth in net profits on year-over-year basis. Fluctuating earnings again are of two types, fluctuating earnings with unsteady net sales and fluctuating earnings with steady net sales. When net sales revenue is unsteady along with unsteady earnings, business might be failing to function properly or might be in turnaround situation. Whereas if business have fluctuating earnings but steady growth in net sales, then prices can get stuck in price range for long time. For example, take a look on chart of Mahindra & Mahindra. Prices are stuck in price range. Now look at its net sales, which has increased steadily from 2014 to 2018. But now take a look on net profits. They have remained unsteady. Now this is the trait that I especially look for while selecting stocks, because these kind of stocks create 52-week high due to economic trigger. Prices in such kind of stocks do not move in anticipation of more earnings, but on anticipation of more net sales or expanding profit margins. On month of April, Mahindra & Mahindra created its 52-week high due to its economic trigger, and that was the signal that I should start looking for buying opportunity in it. And as I mentioned in why I bought GSS Infotech video, I bought it. Now economic trigger may succeed in upside or not, but what remains important is that my risk on investment is extremely low, so I can easily take losses on few stocks and still end up with decent amount of profit. If you want to learn how I analyze my stocks, take a look in description of this video for investing in stocks for big gains. Next type of earnings are quarterly earnings. Quarterly earnings are of 5 types: quarter-over-quarter quarterly earnings, year-over-year quarterly earnings, surprise quarterly earnings, and finally accelerating and decelerating quarterly earnings. In year-over-year quarterly earnings, you compare this quarter's result with last year's same quarter. For example, you compare Q2 result of 2018 with Q2 result of 2017. A steady growth in 4 quarters in a row usually means yearly earnings will be good. This information comes very handy while trying to catch a stock that is on verge of upside. For example, here is chart of Mahindra & Mahindra when I bought it. And here snippet of my analysis document. Here you can see I marked quarterly sales revenue YOY increasing. Though we didn't consider net earnings here, the logic was same, that yearly earnings are likely to increase and it is time to catch the bus. Next is quarter-over-quarter earnings. In this case, we compare earnings of current quarter with last quarter. For example, earnings of Q2 2018 are compared with Q1 2018. If QoQ quarterly earnings are increasing, then it is called accelerated earnings. Similarly, when earnings start to decrease on QoQ basis, then we call it decelerating earnings. Usually deceleration occurs in stock in which acceleration has already occurred. For example, here is chart of HEG. Acceleration in price began in June 2017, around same time when QoQ earnings began. I bought it for 365 and then sold it recently for around 3100. If you have also bought this stock and haven't yet sold, then keep in mind it doesn't take long for acceleration to turn into deceleration. Be ready with your exit strategies. Stock might decelerate anytime. For example, take a look on Rain Industries. Stock accelerated from 62 rupees to 450 rupees and then also decelerated from its high to 232 rupees. Accelerating earnings usually result in quick upside and quick downside. So it is good to join party early and leave early. Here's one more example. Earning acceleration in InSwift Labs started in June 2017 and from that point it has shown all symptoms of successful turnaround. If this acceleration succeeds, then I can expect the kind of profit which I made in HEG. Finally, surprise earnings usually happen in turnaround stocks, where after several failing quarters, business all of a sudden reports good earnings. If people become positive about business's successful turnaround, then after surprise earning, price start rising. After seeing at least 2 quarters of positive growth, you should make a buying decision on any turnaround business. Again, we use same example. After posting failed result for multiple quarters, InSwift Lab posted profit in most recent 2 quarters. And out of those 2, most recent quarter can be called as surprise earnings. It is called surprise earning because size of earning is much bigger than previous earnings. Finally, we will take a look on business model specific earnings, in which we will take a look on steady growing model, growth models, turnaround models and cyclical model. Steadily growing businesses are those businesses which started small, became big and are now so big that they face hard time becoming even bigger. These kind of businesses are businesses that we classify under slow growers or stalwarts. These are businesses that grow for less than 5 to 15% every year. They are big and established businesses and usually there is no one who can challenge their might. Market crash is usually the best time to invest in them, but when it comes to earnings, you cannot expect any surprise from them. These usually are the stocks in which rich people invest. Growth businesses are businesses that are made for retail investors. Their earnings are as high as 25 to 50% of their total equity. In simple words, their return on equity is 25% or more. Ideally, most growth businesses show more than 15% yearly increase in their earnings. Steady earning businesses with ROE above 17 to 25 can be considered as growth businesses. The example of Page Industry was also a growth business example. Next are turnaround businesses. These are usually those businesses which are beaten down in market. They usually make return with breakout year. For example, after posting bad earnings in year 2014, 2015, 2016 and 2017, all of a sudden they end up posting great earnings in year 2018. Increase in yearly earnings usually come from most recent 2 quarters, from which at least one holds huge earnings. The InSwift Labs example we saw before was a good example of turnaround business. Finally, the most mysterious businesses are cyclical. While cyclical businesses keep reporting bad earnings, people may stop pushing prices down. This increases their PE. Strange thing about cyclical business is that when people stop pushing their prices down in spite of bad earnings, they turn around and start posting good earnings. Similarly, while moving up, cyclical businesses keep reporting more and more earnings, then people stop pushing prices up. This results in PE falling significantly, and as PE falls, so does its prices. Behavior of cyclical businesses may sound little weird, but they do act very differently from other stocks. With that said, we have come to the end of this video. Though this can't be called the complete video on earnings of business, I tried to put all information that I had about businesses earning and its influence on price in it. I hope you find this video helpful. With that said, thanks for watching this video and have a nice day.